I wanted to invest for a long time, but was scared to take the plunge. I didn't feel I had an aptitude, understanding, or risk tolerance to deal with the emotions that investing in stocks and shares would bring. If you're thinking about investing for the first time, but have the same fears that I had when I first started out, then let me talk you through index funds and the things that reassured me. Then you can decide whether index funds are the right choice for you. I believe that for a beginner, investing in a passive index fund is a sensible option. However, I'm not trying to convince you either way. I just want to share what I have learned with you to make you better informed and to assist you in coming to your own conclusions. Before we start, I need to tell you that this is a financial education video. I'm not a financial advisor, and anything I say on this channel is my opinion and should not be construed to be financial advice. Please always fact check anything anyone tells you on YouTube, including what I tell you in the videos I create, and do some research on this subject to ensure that investing and your choice of investment is suitable for you and your circumstances. Jack Bogle, the founder of Vanguard, started the first index investment fund in 1975. Heads of other investment companies could not believe that people would be satisfied with average returns, but they were wrong. There were a lot of people out there who didn't want to take crazy risks to get a good return, and were happy to settle for what the market would give them. When talking about funds and investing, Bogle has used various famous phrases including buy everything and own the haystack, not the needle. You can probably work out from these sayings that he was talking about investing in index funds when he said them and not picking individual stocks. So let's find out a little bit more about index funds. An index fund, which is also known as an index tracker fund amongst other names, is a fund which tracks a basket of investments that replicate an index. Examples of indices that a fund might replicate and track are the S&P 500 or the FTSE 100. This means that when you purchase a share in an index fund, you are not purchasing the share in an individual company. You, along with other investors, are pooling together to invest in the fund's underlying assets, and those underlying assets could be hundreds or even thousands of companies that are contained in the index that they are trying to replicate. The premise is that the fund's return should be very closely correlated to the index that they track. There's no attempt to beat this index. If the index increases in value over time, then so will the fund. Given that past annual returns have been between 8 and 9%, such funds should replicate this and beat inflation and any fixed rate savings account that you might prefer into the bargain. Index funds come in different shapes and forms, but two of the most common ones are mutual funds and ETFs. Both are good choices for a beginner passive investor. ETFs tend to have cheaper ongoing charge figures, OCFs. This is the charge that the owners of the instrument make to administer this collective investment. Whether it's an ETF or a mutual fund, they are generally low cost as long as they're passive funds. And you have the ongoing charge figure or the total expense ratio, depending on which fund you're looking at, to compare, which is readily available. Both ETFs and mutual funds can be passive. This means that they track an index. They're designed to deliver the return of the index and not to try and better it, as would be the case with an active fund, which will involve regular stock picking and adjustments to try and stay ahead of the index benchmark. This regular tinkering comes with extra costs that you should take into account when looking at potential returns of past performance. Funds of higher cost have to beat their fees as well as the benchmark, something that a high number then fail to do consistently. Passive index funds just try to replicate the market and replicate the market risk. Active funds try to beat the market and therefore generally have to take on additional risk to do so. You can purchase ETFs or mutual funds through stockbrokers or investment platforms. Both can be structured as accumulating or distributing. Some like the accumulation option better, as you don't have to pay the dividends back in manually if you continue to reinvest. This means even less to worry about if you just want to invest and forget. With distributing funds, you get paid the dividends, and when you get paid the dividends, it won't automatically be reinvested for you. So we've spoken a little bit about index tracker funds. Now let's talk about the indexes that they track. Indexes are designed to follow some preset rules. These can be based on things such as geographical region, the size of the businesses. The index then lists the companies that are accepted as meeting the rules, often in order of the company's size, and tracks the performance of all these companies collectively. If more companies are doing well, then it's likely that the index will rise, and vice versa. The S&P 500 index tracks the 500 largest companies in the USA. Given their size, these companies are known as large cap companies. The index itself, the S&P 500, is subject to market capitalization, meaning that the larger companies within the index get a greater share of it. The likes of Apple, Tesla, Microsoft account for some of the larger weightings within the S&P 500 index. If Apple accounts for 6% of the index that your fund tracks, every time you invest in the fund, 6% of what you invest in will be invested in Apple stocks and shares. If the fund you invest in is accurate, then your investments will have similar weightings and the fund should rise and fall in line with index movements. There are funds that track global indexes. An example of one that you would have access to in the UK is the FTSE Global All Cap Index Fund. All cap meaning large, medium and small companies. This has over 7,000 holdings, meaning that to invest in this fund is to invest in over 7,000 companies worldwide. There are also multi-asset funds that consist of stocks, shares and bonds, for instance. An example of these type of blended funds would be the Vanguard Life Strategy range. Why then might it be a good idea to invest in a passive index tracker fund? By investing in an index fund means that you can still invest in a company that you have an interest in, if that's what you want. If you invested individually in a single company, you would be directly exposed to that company's fortunes and could lose all your money should the company fail or perform badly. Investing in a fund means that your exposure to risk is spread across all the companies in the index. There would all have to be a failure across the other companies in that index to cause the same impact on your portfolio that investing in a single company would have caused. This is much less likely. You can liken a diverse fund that you choose to a cross-section of the economy, given that it is generally spread widely over a large selection of assets. You could choose a fund that is so diverse that it invests globally and across various sectors and asset classes in thousands of companies. This would hopefully provide protection if the market crashes, as some countries, sectors and asset classes might not be exactly correlated, so some might perform better than others during market stress situations, thus ironing out losses that an investor might incur. A crude way of looking at diversification might be to use weather as a factor. If your portfolio consists of these two companies, one sells raincoats and the other sells ice cream, one will invariably be a drag on its performance as the other performs well in given weather conditions and could dampen your growth, but will hopefully also restrict losses. Diversification should make your investment journey a little less emotional whilst still reaping sufficient reward for the risk that you take. Remember that diverse index funds can generate returns of between 8 and 9% in the long term if you go by past performance. Investing in index funds or ETF is a far cheaper way to achieve diversification than having to purchase shares in individual companies and pay the commissions that those purchases make. If investing in individual stocks, you would need to purchase enough shares across various companies to achieve this diversification. Can you imagine the cost of doing this individually? It's argued that you could only diversify sufficiently if you invest in anything between 6 and 32 companies, depending on what you're invested in. Vanguard S&P 500 charges just 0.07% ongoing charge figure OCF. And that's value because you get to invest in 500 companies for that. Funds have to publish their OCFs and it is therefore easy for you to compare the costs of different funds. It's a good idea to try and keep your costs as low as possible so as not to eat away at your investments. So choosing a low-cost fund on a low-cost investment platform makes sense. All index funds that are aimed at us, retail investors, have to be regulated. Just because a fund is regulated does not mean that it cannot perform badly. Remember that your capital is at risk from investing and that you could bring back less than you put in. With passive index funds, the work is already done for you. You can just put your feet up, invest regularly and relax. It tracks the index that you have chosen and you need not do anything more than continue to invest regularly. If you invest in an individual company, you're going to have to research the balance sheet of that company. You're going to have to compare the balance sheet of that company with comparable companies, and that research is going to be ongoing. Additionally, you're going to have to do that with a whole load of companies if you want to achieve diversification. This will not be realistic for 99% of investors, and the 1% for professionals that it would be okay for would be devoting a lot of their time and effort into doing this. Investing in passive index funds reduces costs, as you're not paying for the privilege of a fund manager tinkering with your assets to try and beat the market. Passive investing means that you're happy with the projected returns that you will get from the market. Investing in an actively managed fund could cost you a lot more and, according to a lot of experts, active funds tend not to actually beat the passive index funds in the longer term, and often have to take on additional risk in failing to do so. Passive index funds could possibly give you access to assets that might have been out of your reach if you tried to invest in them individually. Certain asset types, such as bonds, require large purchase amounts that might push them out of reach for some, whereas purchasing bond funds is relatively cheap. Passive index funds generally have good liquidity, meaning that you can get access to your money in relatively short time if required. The easiest place to find funds and ETFs will be on an investment platform. These are the equivalent of stockbrokers but online, and there are numerous established platforms out there to choose from. These platforms also have fees for you holding and purchasing assets on their platforms. It is worth shopping around to find a platform that suits your need, as they will have different price structures. Whatever you choose, do your own research and compare fees. I would be really interested to hear what your choices are, so please comment in the box below and tell me what you're investing in. So once you've worked out what your goals are and what your tolerance for risk is, choose your investment platform. The lower cost the better to start. Then decide on what type of fund you want to invest in. Remember, you might want to keep this passive, less work and decisions to make for you, and diverse. Check the cost of the individual fund you are choosing. Look at the fund's past performance. This past performance does not mean that your fund will continue to perform that well in the future, but at least gives you an indication of what you might expect to get from the fund going forward. Read the key investor information document that is attached to any fund that you wish to purchase. You can normally find this on your funds page as a summary or as an attachment. It gives you a lot of information about that fund. Very useful. Consider the type of account that you open on the investment platform of your choice. For example, a stocks and shares ISA will protect your investments and gains from tax, and you have a £20,000 allowance each year to pay into one of these. Use research sites such as Morningstar and Just ETF. There's also another one out there which I've recently discovered called pickafund.com. These sites allow you to filter funds with your preferences. For instance, you could filter funds to be global, low cost and with good ratings. Nothing involving money is risk-free. Even using savings accounts for your cash is not risk-free. It is unusual for interest gained on savings to consistently outstrip inflation, and your money will probably lose value or purchase power the longer it remains in a savings account. You might not physically lose any money in your bank accounts, but the underlying effect of inflation in eroding cash investments could have a far greater impact than losses from investing in stocks and shares. There are some that say that the biggest risk that you can take with your money is not investing it. Well, I hope that this video has been of use to you, and if you are a first-time investor or you are looking to invest in the near future, that I have allayed some of your fears. Thanks very much for watching this video today. It is much appreciated. Please can I ask you to click on the like button if you enjoyed what you saw today, and also to consider subscribing to my channel if you haven't already done so. And then if you click that notification bell, you'll know when I post new videos as well. Thanks very much for watching today. I hope to see you soon. Bye.